America is risking its money system in real time? Inside the White House, crypto executives and bank lobbyists sat down to break a deadlock that could decide where your money lives next. Fact, the Clarity Act is stalled over one issue: whether crypto platforms should be allowed to pay rewards on stablecoins. Fact, the president said in the Oval Office, if we don't do crypto, then China's going to do it. That's the contradiction. Banks warn that rewarding stablecoins could trigger a massive flight of capital out of deposits. Crypto leaders warn that blocking it hands China a first-mover advantage in digital currency. And this isn't theoretical. If money starts earning returns outside banks, your savings behavior changes. Borrowing costs shift, and the global demand for the US dollar moves with it. Inference. This fight isn't about technology. It's about control over where value sits in a digital economy. But here's where the story flips. One side says delay equals disaster. The other says action does action. Only one of them is right, and the consequences are already forming. So which risk is the real one? What actually happened yesterday looks procedural on the surface, but it isn't. Fact, White House officials met with crypto companies, including Coinbase and major bank associations, to break the stalemate freezing the Clarity Act in the Senate. Participants called the talks constructive, yet crypto representatives reportedly felt banks were slow to engage. That detail matters. This wasn't a technical disagreement. It was a power standoff. At the center of it is one question lawmakers still won't answer directly. Should crypto platforms be allowed to reward customers for holding stablecoins instead of keeping money in banks? Supporters say this strengthens the dollar and boosts competitiveness. Critics say it could pull billions, even hundreds of billions, out of the banking system. Notice what's missing here. No one is disputing that money would move. The argument is over whether that movement is a threat or a feature. And that reframes the entire issue. This isn't crypto versus banks. It's an argument about where demand for dollars should live in a digital world. Now watch how fast this escalates once China enters the frame. The strongest claim from crypto advocates is blunt. Blocking stablecoin rewards doesn't protect the system. It weakens it. Fact, the president said in the Oval Office, I'm a big crypto person. If we don't do it, China's going to do it. Fact. Coinbase's chief legal officer warned it would be a disaster for America if a Chinese central bank digital currency replaced the dollar's role globally. That isn't rhetorical fluff. He tied it to mechanics. Fact, stablecoins are described as driving demand for U.S. dollars and being backed dollar for dollar by short-term instruments, principally U.S. treasuries. The implication is clear. More stablecoin use means more dollar demand, lower borrowing costs, and reinforcement of the dollar's position in global trade. But notice what they didn't deny. They didn't say rewards wouldn't pull money out of banks. They said there's no evidence whatsoever that it harms deposits. That's a subtle but important distinction. Movement is real. The dispute is about damage. And here's the part that quietly raises the stakes. If stablecoins are already backed by treasuries, the battle isn't about safety. It's about who gets to sit between you and your money. And that's where resistance hardens. This is where the tension stops being theoretical and starts looking familiar. Fact, banks are lobbying to limit stablecoin rewards, warning of a massive flight of capital. Billions, tens of billions, even hundreds of billions leaving deposits. That language matters. It echoes past moments when incumbents warned that change itself was the danger. But here's the flip. Crypto executives aren't arguing that money won't move. They're arguing that the current system already traps capital. Fact, bank representatives were criticized for holding more than $3 trillion parked at the Federal Reserve, just sitting there, according to the crypto side. That's not a fringe accusation. It reframes the fear. The question becomes, is money leaving banks a crisis, or is money being immobilized the real risk? Historically, systems don't break when new channels appear. They break when old ones refuse to adapt. And notice how this is being normalized. A fight over whether customers can earn rewards on digital dollars is now being treated as a threat to financial stability. That alone signals how much leverage is at stake. Because once rewards are allowed, the logic of the system shifts, and rolling that back becomes almost impossible. Now the pressure stacks quickly. Fact, critics accuse crypto platforms of wanting rewards without anywhere near the regulatory framework banks face. Fact, in response, crypto executives point to the Clarity Act placing the industry under federal supervision for the very first time. At the same time, they draw a sharp line. Fact, stablecoin deposits are described as not being lent back into the economy, but backed dollar for dollar, mainly with U.S. treasuries. Then comes the third layer. Fact, the Genius Act is already law, and under it, stablecoin rewards are explicitly allowed. That means even if clarity fails, rewards don't disappear. They continue. This is where the system starts to lose control. Banks are fighting to stop something that legally already exists. Lawmakers are debating guardrails for a train that's already moving, and regulators are being asked to promise safety while the structure itself is changing underneath them. Now watch what happens when speed enters the equation. More platforms expand, more services stack, more money finds alternatives faster than rules can keep up. And once consumers get used to earning returns outside banks, reversing that behavior becomes politically radioactive. So the real question isn't whether this is safe, it's what happens if this continues. Now bring this down to where it actually hits you. Not on Capitol Hill, not in a hearing room, but in everyday decisions. Fact, crypto platforms are expanding beyond trading into direct deposit, stock trading, prediction markets, and what executives openly call an everything exchange. That matters because it changes behavior. If one app lets you hold money, earn rewards, trade assets, and move funds instantly, the friction you've accepted for years starts to feel unnecessary. Inference. Loyalty to banks has never been emotional, it's been structural. People stay because switching is hard. This lowers that barrier. And notice how the criticism shifts when this comes up. Instead of talking about innovation, critics warn about rural areas, community banks, and access to credit. Fact, crypto executives respond by claiming these tools could engage those communities for the very first time. Strip away the ideology and what's left is simple. If your money works harder elsewhere, you will notice. If access becomes easier, you will test it. And once enough people do, the system adapts around them, not the other way around. If this feels familiar, say so in the comments. Because what looks like a policy debate is quietly becoming a behavioral shift. Step back from the personalities and the headlines, and the mechanism comes into focus. Fact, the core argument isn't about liking or disliking crypto, it's about incentives. Banks operate on a fractional system. Stablecoins, as described here, are backed dollar for dollar with short-term U.S. treasuries. That difference changes the leverage. When rewards exist on stablecoins, demand for dollars doesn't disappear, and it relocates. And whoever controls that layer controls visibility, data, and flow. This is why the debate feels unusually tense. It isn't about safety alone. It's about losing the middle position between you and your money. Add geopolitics and the stakes rise again. Fact, China is already offering a central bank digital currency and providing yield on it. Fact, crypto executives warn that if the U.S. hesitates, leadership doesn't pause, it transfers. This is the unsettling insight mainstream coverage misses. Systems don't wait for permission. They move toward lower friction and clearer incentives. Regulation can guide that movement, but delay doesn't freeze it. It redirects it elsewhere. And once redirected, pulling it back is far harder than shaping it early. Now, the next move starts to take shape. From here, the trajectory splits and neither path is clean. One direction is speed with structure. Fact, supporters argue the Clarity Act would extend oversight beyond stablecoins, create a clear token framework, and bring spot markets under federal supervision for the first time. In that scenario, rewards continue, platforms expand, and the U.S. locks in a lead while rules catch up alongside growth. The other direction is delay. Fact, even without clarity, the Genius Act remains law, and stablecoin rewards stay legal. That means behavior changes anyway, just without a unified framework. More platforms move first. More services stack faster than regulators can coordinate. And the center of gravity shifts quietly. Outside, the system lawmakers are trying to protect. Notice the asymmetry. Passing legislation shapes momentum. Failing to pass it doesn't stop momentum. It hands it to whoever is already moving. Add China's stated intent to push its own digital currency with yield, and hesitation starts to look less like caution and more like surrender by default. Nothing here guarantees collapse or dominance. But one thing is already clear. The next phase isn't coming later. It's forming now while the argument is still unresolved. The lasting insight here isn't about crypto, banks, or even China. It's about timing. Fact. Lawmakers are debating guardrails while the public is already being offered alternatives that feel faster, simpler, and more rewarding. Fact, stablecoin rewards are legal today. Meetings are happening now, and platforms are openly positioning themselves as the primary financial account of the future. Put together, the story reframes itself. This isn't a fight over whether change should happen. It's a fight over who gets to shape it before habits lock in. Once people adjust how they hold and move money, systems reorganize around that behavior, not the other way around. That's why this moment matters. Delay doesn't preserve the old order. It quietly trains people to live without it. And here's the loop to hold on to. Every major financial shift looks technical at the start. Then suddenly it feels inevitable. We're still in the window where decisions matter, narratives form, and power hasn't fully settled. The next move in Washington, in markets, or abroad will tell us which path hardens first. And that's the layer we'll be watching closely. Follow and stay with me because this story doesn't slow down from here.